welcome back to Prime Wealth. We're so glad you're joining us today.
Absolutely. It's great to be here. Today, we're diving into a topic that's super important for anyone looking to secure their financial future, investing in bonds.
Right. We're going to explore the differences between government and corporate bonds. It's a crucial distinction, especially for those of you over 40, looking to enhance your investment strategy.
Exactly. And we'll break down how each type of bond works, the risks involved, and the potential returns you can expect.
Plus, we'll share some practical tips on how to choose the right bonds for your portfolio, considering your financial goals and risk tolerance.
And we'll also touch on the current market trends, so you can understand what's happening out there and how it might affect your investment decisions.
It's a lot to unpack, but by the end of this episode, you'll have a clearer picture of whether government bonds or corporate bonds might be the right fit for you.
So let's get into it. What's the first thing we should know about government bonds?
You know, Alex, as we talk about investing in bonds, I can't help but think about how many people over 40 are really feeling the pressure right now, especially with all the economic uncertainty out there.
Absolutely, Jordan. It's a critical time for many. Folks are approaching or already in their peak earning years, and the choices they make now can significantly impact their retirement plans.
Right. And with inflation being a hot topic lately, it's hard to ignore how it can eat into savings and investments. It can feel like a race against time, especially when you consider that many people in their 40s and 50s are looking at a retirement timeline that's not too far off.
Exactly. Imagine someone who's in their mid-50s. Maybe they've been investing in stocks, but with the recent volatility, they're starting to feel anxious. They might wonder, is this really the best way to secure my future? That's where bonds come into play.
And it's not just about the numbers, is it? There's an emotional aspect too. People want to feel secure and confident about their financial future, and seeing the market swing can create a lot of stress.
Yes, the emotional side of money is often overlooked, but it's so vital. Many individuals, especially those in their 40s and 50s, want a balanced approach to investing. They've worked hard and want to protect what they've built, while also looking for growth.
So how do bonds fit into that picture? I know there are government bonds and corporate bonds, but what's the real difference in terms of security and return?
Great question. Government bonds, like U.S. Treasury bonds, are considered one of the safest investments because they're backed by the government. They typically have lower yields compared to corporate bonds, but they offer more stability.
That makes sense. So for someone looking for a safe haven for their money, government bonds could be a great option, especially with all the market fluctuations.
Exactly. They're often appealing for those who are risk-averse. But on the flip side, corporate bonds can offer higher yields. However, they come with more risk, depending on the company's financial health.
So it's a balancing act then.
Definitely. Let's say you have someone maybe in their early 50s who has a mix of stocks and bonds. They might choose to put a portion of their money in government bonds for stability while allocating some to corporate bonds to chase higher returns.
And that could be particularly important right now, considering how inflation impacts purchasing power. Higher yields from corporate bonds could help offset that, right?
You got it. But it's important to look at the credit ratings of those corporate bonds. A strong credit rating indicates less risk, while a lower rating implies a greater chance of default.
So it's like choosing between a safe, steady path and a riskier, potentially more rewarding one. I can see how that's a tough decision for many.
Yes, and life stage matters too. Someone nearing retirement might lean more towards government bonds to preserve their capital, while someone younger might feel comfortable taking on more risk with corporate bonds.
I've heard stories of people who have been burned by risky investments, especially when they're close to retirement age. It's heartbreaking to see someone's plans derailed because they were chasing high returns without a solid strategy.
It really is, and that's where having a diversified portfolio becomes crucial. By spreading investments across both types of bonds, as well as other asset classes, investors can mitigate risk while still aiming for growth.
So let's say someone is in their late 40s and they're thinking about their bond options. How should they approach this?
First, they should assess their risk tolerance and financial goals. If they're looking for a reliable income stream to supplement their retirement, government bonds might be a good starting point. But if they're willing to take on some risk for potentially higher returns, They can explore corporate bonds.
And what about the timing? With interest rates fluctuating, how does that play into bond investing right now?
Great point. When interest rates rise, bond prices typically fall, and vice versa. So if someone is looking to enter the bond market now, they might want to consider how current rates could impact their investment.
It's like timing the market, but in a different way, right?
Exactly. If someone can lock in a higher yield with government or corporate bonds before rates go up further, that could be beneficial.
I can see how people might feel overwhelmed by all of this, especially if they're not familiar with bond investing.
It can definitely feel that way, but the key is to start small and educate yourself along the way. Look for resources, maybe even speak with a financial advisor to get tailored advice.
That sounds like a solid plan. You mentioned earlier about the emotional side of investing. How do you think people can manage that, particularly when it comes to bonds?
I'd say it's essential to set clear financial goals. Knowing what you're working towards can help alleviate some of that anxiety. Plus, having a diversified investment strategy, including bonds, can give peace of mind knowing you're not putting all your eggs in one basket.
That definitely makes sense. It's like having a safety net, right?
Exactly. And that's what bonds can provide, a level of protection against market volatility, especially for those who are approaching retirement.
So with all of this in mind, what are some practical steps someone can take to start investing in bonds today?
Well, first, they might want to assess their current financial situation, then determine their risk tolerance. After that, they can research different bond options, maybe even consider bond funds for easier diversification.
And I imagine starting small is a good approach, especially if they're feeling uncertain.
Yes, starting small allows for gradual learning and adjustment. It's about building confidence in your investment strategy, and with time, they can increase their bond holdings as they become more comfortable.
That's really encouraging. It feels like a journey, one that can lead to more financial peace of mind.
Absolutely. So those are some immediate steps you can take. Now let's bring everything together. So when we talk about investing in bonds, it really helps to start with understanding the differences between government bonds and corporate bonds.
Right, and that's crucial because they serve different purposes in your portfolio. Government bonds are generally seen as safer, right? They're backed by the government.
Exactly. When you invest in government bonds, you're essentially lending money to the government, and they're considered low risk. You might not get the highest returns, but the stability can be very reassuring, especially for those nearing retirement.
That's true. So if someone is looking for security, government bonds might be a good place to start. But what about corporate bonds? They can offer higher yields, right?
Yes, corporate bonds can indeed provide higher interest rates because they carry more risk. Essentially, you're lending money to a company, and if that company struggles, there's a chance they might default on their bond.
So it's really about balancing risk and reward, isn't it? If someone is considering investing in corporate bonds, what should they look for?
Great question. First, check the credit rating of the company. Ratings from agencies like Moody's or S&P give you an idea of the company's financial health. Higher-rated bonds are generally less risky.
And what about the term? How does that factor in?
The term, or maturity date, is crucial. Short-term bonds may be less sensitive to interest rate changes, while long-term bonds can give you a better yield but come with more risk due to market fluctuations over time.
So if someone is looking to lock in a rate for a while, long-term bonds might be appealing, but they need to be aware of those fluctuations.
Exactly. And here's a handy rule of thumb. If you're closer to needing that money, like for retirement or a big purchase, stick with shorter maturities. It reduces the risk of losing value if interest rates rise.
That makes sense. And speaking of interest rates, how do they affect bond prices?
That's a critical point. When interest rates go up, bond prices generally fall. And conversely, when rates drop, bond prices tend to rise. So if you hold a bond and rates go up, your bond's value can decrease.
That's something to keep in mind, especially for those who might need to sell their bonds before maturity.
Yes, and it's why maintaining a diversified bond portfolio is essential. You can mix government and corporate bonds and even include municipal bonds, which can offer tax advantages.
Right, and for someone just starting out, how would you suggest building that diversified bond portfolio?
A practical step is to determine your risk tolerance first. Are you comfortable with more risk for potentially higher returns, or do you prefer a conservative approach? Based on that, you can allocate a percentage of your portfolio to different types of bonds.
So if someone is more risk-averse, they might lean towards a higher percentage of government bonds, while someone willing to take on more risk might include a larger share of corporate bonds.
Exactly. A simple formula could be, if you're 50% government bonds and 50% corporate bonds, adjust that based on your comfort level. Maybe you go 70% government if you want more security.
And what about bond funds? Are they a good option for diversifying without needing to pick individual bonds?
Absolutely. Bond funds allow you to invest in a collection of bonds, spreading out the risk even further. They can be a great way to get exposure to various types of bonds without having to manage individual investments.
That's a smart choice for many investors, especially for those who might not have the time or knowledge to dive deep into individual bonds.
Right, and many people overlook bond ETFs, which can be traded like stocks. They have lower fees and can provide instant diversification.
So, what's the best approach for someone looking to invest in bonds right now? Any specific steps?
Well, start by assessing your overall financial situation. Consider your income needs, risk tolerance, and investment horizon. Then, research and compare different bonds or bond funds that fit your criteria.
And it's important to consider the current interest rate environment too, isn't it?
Definitely. Keeping an eye on interest rates can help you time your bond purchases better. If rates are expected to rise, you might want to focus on shorter-term bonds for now.
That's really practical advice. And let's not forget about the tax implications, especially with municipal bonds. They can be a great choice for someone in a higher tax bracket, right?
Exactly. Municipal bonds are often tax-exempt at the federal level, and sometimes at the state level too. They can be a smart investment for those looking to minimize tax liability while still earning income.
So it seems like there's a lot to consider when investing in bonds. But can you give us some common pitfalls to avoid?
Sure. One major pitfall is not doing enough research before investing. Understanding each bond's credit rating and the economic factors that affect interest rates is essential. Also, be wary of chasing high yields without considering the associated risks.
That's a good point. Another thing people often overlook is the importance of liquidity, right?
Exactly. If you invest in bonds, make sure you have enough liquidity in your overall portfolio. You don't want to get stuck needing cash while holding on to bonds that can't be easily sold.
And those fees can add up too, especially with bond funds.
Yes. Always read the fine print on fees associated with bond funds or ETFs. High fees can eat into your returns over time.
It sounds like understanding bonds really comes down to doing your homework and being aware of what you're investing in.
Absolutely. The more you know, the better decisions you can make for your financial future.
So as we transition to discussing those common pitfalls, remember that being informed and cautious can help safeguard your investments.
Right. Let's dive into those pitfalls.
You know, Alex, when it comes to investing in bonds, I think a lot of people have a tendency to overlook some of the common pitfalls.
Absolutely, Jordan. It's easy to get caught up in the allure of a seemingly safe investment. But bonds can come with their own set of challenges.
Right? So what do you think is one of the biggest mistakes people make when investing in bonds?
One major mistake is not understanding the credit quality of the bond issuer. For instance, a corporate bond might offer a higher yield than a government bond, which can be tempting. But if the company is struggling, that higher yield can come with a lot of risk.
Yeah, I can see how that could backfire. Like, if someone invested in a corporate bond from a company that later went bankrupt.
Exactly. They could end up losing a significant portion of their investment. A real-life example is when a well-known retailer declared bankruptcy. Investors who had bought their bonds were left with almost nothing.
Ouch, that's tough. So how can someone recognize that kind of risk ahead of time?
A good place to start is by checking the bond's credit rating. Agencies like Moody's or S&P provide ratings that can give you insight into the issuer's financial health. If the rating is low, that's a red flag.
And I suppose another common mistake is not diversifying enough, right?
Definitely. Many people think that just buying a few bonds will provide enough diversification. But if all those bonds are from similar sectors or have similar risks, they're not really spreading their risk.
So someone might think they're diversified, but in reality they're not?
Exactly. For example, if someone invests heavily in tech company bonds during a tech boom, they might be in trouble when the market shifts. It's all about having a balanced portfolio.
And that balance can help offset any downturns, right?
Exactly. Diversifying across different sectors, types of bonds, like government versus corporate, and even different maturities, can really help smooth out the bumps in your investment journey.
Speaking of maturities, I've heard that people sometimes misjudge the impact of interest rate changes on bond prices.
Yes, that's another common pitfall. Many investors don't realize that bond prices move inversely to interest rates. When rates go up, bond prices typically go down.
So if someone buys a long-term bond and rates rise significantly, they could lose a lot of money if they need to sell it before maturity?
Exactly. A great example is back in 2020, when interest rates were at historic lows. Investors flocked to long-term bonds, thinking they were making a safe bet. But as rates started to rise, many found themselves holding bonds worth significantly less than what they paid.
That must have been a tough lesson for some folks.
It really was. The takeaway here is to be aware of the interest rate environment when investing in bonds. Sometimes, shorter maturities can be less risky in a rising rate scenario.
And I imagine that's especially true for people who are closer to retirement.
Absolutely. For those approaching retirement, it's crucial to consider how much risk they're willing to take on. A sudden drop in bond prices could impact their income, especially if they're relying on that for their living expenses.
And then there's the issue of liquidity, right? Some bonds can be much harder to sell than others.
Exactly. If you invest in less commonly traded bonds, you may find it difficult to sell them quickly without taking a loss. It's essential to look at the bond's liquidity.
So how can investors ensure they're making wise choices in that regard?
One approach is to stick with bonds that are more actively traded, like U.S. Treasury bonds or large corporate bonds. Those tend to have better liquidity, making it easier to sell when needed.
And what about the fees associated with bond investing?
That's a great point. Many investors overlook the costs associated with buying and selling bonds, especially if they're using a broker. High fees can eat into your returns over time.
So, being aware of those fees is important too.
Definitely. It's worth shopping around for brokers and understanding what those costs will be. It can make a significant difference in your overall returns.
And I suppose people sometimes get too focused on yield without considering the overall risk.
Right. That can lead to bad decisions. Chasing yield can cause investors to overlook other critical factors like credit quality or liquidity. It's important to balance yield with the risks involved.
So, it's not just about what looks good on paper, but really understanding the full picture.
Exactly. If an investment looks too good to be true, it probably is. Taking the time to do your homework can save a lot of headaches later on.
And that homework can help you identify those danger signs before it's too late.
For sure. Regularly reviewing your bond holdings and staying informed about market conditions can help you catch potential issues early.
So, if someone recognizes they've made a mistake, what can they do?
The first step is to assess their portfolio. If they've overexposed themselves to high-risk bonds, it might be time to rebalance. Selling off some of those higher-risk assets and reallocating into more stable investments can help.
That makes sense. It's about making adjustments based on what you've learned, right?
Exactly. And remember, it's never too late to reevaluate your strategy. The important thing is to stay proactive and informed about your investments.
So those are some immediate steps you can take. Now let's bring everything together. So let's dive into some concrete steps our listeners can take right away if they're thinking about bonds, whether government or corporate.
Absolutely. First off, I'd recommend starting with a simple checklist. You want to clarify your investment goals. Are you looking for stability, income, or maybe a balance of both?
Right, and once you've identified your goals, it's also crucial to assess your risk tolerance. Bonds can be less volatile than stocks, but there are still risks involved, especially with corporate bonds.
Exactly. You can use online tools to assess your risk tolerance. Many brokerage platforms have questionnaires that can help you figure this out.
Speaking of platforms, what are some good apps or websites our listeners can use to start investing in bonds?
Well, a few solid options include Fidelity, Vanguard, and Charles Schwab. They all offer user-friendly interfaces and educational resources about bonds.
And what about for those who might be new to investing? Are there specific funds or ETFs that focus on bonds?
Definitely. Bond funds or ETFs can be a great way to start, especially if you're not ready to pick individual bonds. Look for ones that focus on government bonds for a safer option, or diversified corporate bond funds for potentially higher yields.
That makes sense. And for someone who wants to start small, how much do you think they should invest initially?
You don't need a ton of money to get started. Many platforms allow you to invest with as little as $100. It's about getting your feet wet and understanding how it all works.
Right, and speaking of understanding, are there any books or resources you'd recommend for someone wanting to learn more about bonds?
There are a couple of great titles I'd suggest. The Bond Book by Annette Thau is a classic and provides a comprehensive overview. Another good one is Investing in Bonds for Dummies. It breaks things down really well.
Those sound helpful. And what about habits? What kind of investing habits do you think our listeners should start developing?
A key habit is to stay informed. Set aside time each week to read up on market trends and bond news. This not only keeps you engaged, but also helps you make informed decisions.
That's a great point. And maybe even consider setting up automatic contributions to a bond fund or ETF.
Yes, automating your investments can help you stay consistent without having to think about it too much. Just set it up and let it work for you over time.
And how about engaging with a community? Is that something you'd recommend?
For sure. Joining investment clubs or online communities can provide support and insights. Platforms like Reddit or even Facebook groups can connect you with others who are also investing in bonds.
That's a fantastic idea. It's always good to have a support system, especially when you're starting out.
Absolutely. And don't shy away from asking questions, whether it's in those communities or with a financial advisor.
So if someone is feeling overwhelmed, what's the best way to break it down and take action?
Start simple. You could begin by just researching a couple of bond ETFs, reading up on them, and maybe setting aside a small amount to invest.
Yeah, and even just tracking your investments can be a good starting point.
Exactly. Set up a spreadsheet or use an investment tracking app to monitor your progress. It'll give you a clearer picture of how your investments are performing.
And remember, investing is a journey. It's all about taking those small, consistent steps.
Well said, Jordan. Every little bit adds up over time, and the key is to stay patient and stick with it.
So those are some immediate steps you can take. Now let's bring everything together in the outro. So let's take a moment to recap what we've discussed about investing in bonds, specifically the differences between government and corporate bonds.
Right. First off, we highlighted that government bonds, like U.S. Treasuries, are generally seen as safer investments, backed by the government's credit.
Exactly. And then we talked about corporate bonds, which can offer higher yields, but come with more risk due to the potential for company default, right?
Yes, and that's a crucial consideration. We also touched on how the bond market can be influenced by interest rates, where rising rates can impact bond prices negatively.
Definitely. And we mentioned the importance of diversifying your bond portfolio, combining both government and corporate bonds to balance risk and return.
That's a smart strategy, especially for those looking to build long-term financial security.
It really is. So as you think about your investment options, remember to weigh the safety of government bonds against the higher potential returns of corporate bonds.
And don't forget, it's about aligning your bond investments with your overall financial goals and risk tolerance.
Exactly. So as we wrap up, just remember that understanding these fundamentals can really empower you in your investing journey.
And if you found this episode helpful, please like and subscribe. And we'd love to hear your thoughts in the comments.
Sharing this podcast with someone who's over 40 could really make a difference for them too.
Absolutely.
Next time, we'll dive into thematic ETFs, exploring exciting areas like AI, clean energy, and biotech.
It's going to be a fascinating discussion, so don't miss it.
Thanks for joining us today.
Take care, everyone.